Welcome to A2Z of economics. Today let's dive into the International Monetary Fund, or IMF. The International Monetary Fund is like a global emergency bank for countries. When a country is in financial trouble, like running out of money to pay for imports, repay loans, or stabilize its currency, it can go to the IMF for help. The IMF lends money but also gives advice on how to fix the country's economy. However, the advice is sometimes tough and can affect ordinary people. Imagine a country called Econoland. Econoland is facing big problems. It imports more than it exports. It's running out of foreign currency. It can't repay its debts to other countries and banks. Its own currency is falling in value. Econoland is stuck. So it goes to the IMF and says, "We need help. Can you lend us money?" The IMF agrees but says, "Yes, but only if you make some changes to how you run your economy." These changes may include cutting government spending called austerity, reducing subsidies like cheap electricity or food, opening up the economy to global trade, privatizing government-run companies. These are part of what's called the Washington Consensus, a common set of reforms the IMF often recommends. While the IMF's goal is to fix the economy, its advice can feel harsh. In Econoland, government cuts might mean less money for schools or hospitals. Prices may rise when subsidies are removed. Jobs may be lost in the short term. So people say, why should ordinary workers suffer while rich lenders get paid back? That's why the IMF is often criticized, even though its goal is to bring long-term stability. In short, the IMF is like a doctor for countries in financial crisis. It gives loans and economic advice, but its treatment, austerity and reforms, can be painful, especially for ordinary citizens. For more updates, do subscribe, fellow investors.